When a partnership sells property at a loss, that loss is usually deductible. But if the sale is directly or indirectly between related parties, the loss is not currently allowed. On the EA exam, this shows up as a trap. You compute a loss, then you're told the buyer is related, and the correct move is to disallow or suspend the loss instead of deducting it now. For partnership-to-partnership sales, the key is ownership attribution. An individual is treated as owning partnership interests held by certain family members. That means two separate partnerships can be related if majority ownership in each is held by people who are related under the family rules. So you don't just look at the entity names, you look through to who owns them. Memorize the family list they actually count. Included family members are siblings and half-siblings, spouse, ancestors like parents and grandparents, and lineal descendants like children and grandchildren. Here's the weird part. Lots of people you'd assume are family do not count for this rule. The EA exam loves asking which relatives are excluded. So what happens to the loss? It's not gone forever. Think suspended. In the classic setup, Partnership A sells property to Partnership B at a loss, and the partnerships are related because of attributed majority ownership. The loss is suspended and generally becomes usable when the property is later disposed of in a non-related party transaction. Translation: the tax system waits for a real outside sale. Use the sibling example mindset. If Addie owns more than 50% of one partnership and her brother Mason owns more than 50% of another, those partnerships can be treated as related. If one sells property to the other at a loss, you don't deduct the loss now. You flag it as suspended. Exam tip: if ownership is 50% exactly, be careful. Questions often hinge on more than 50%. Marcus is a 50% partner in Harborview Advisors. His share for the year is an ordinary business loss of $300,000 and a capital gain of $12,000. His basis before these items is $240,000. Based on the basis limitation rules, what amount of losses are disallowed and carried over? Think about it. The carryover is $48,000. Basis is increased first by the $12,000 capital gain, bringing basis to $252,000. Then you apply the $300,000 ordinary loss, but he can only deduct losses up to basis. The excess, $300,000 minus $252,000, is $48,000 carried forward. The tempting wrong move is ignoring the gain increase. When a partnership distributes property to a partner, what happens to the partner's holding period for that property? Is it based only on the distribution date? Does it tack on the partnership's holding period? Does it depend on how long the partner owned the partnership interest? Or does it not include the partnership's holding period? Think about it. The holding period generally includes the period the partnership held the property, so it tacks on. That matters for long-term versus short-term treatment when the partner later sells the asset. A common wrong answer is that the clock restarts on the distribution date, but that's not the general rule tested on the EA exam.